Let's take a look at your market news now. Fears of a trade war between the world's top two economies weighed on Asian stocks today. Several regional bourses closed in the red despite a recovery on Wall Street stocks last night. It follows China's retaliation against the US imposing import tariffs on $50 billion worth of 1,300 Chinese products. Overnight, China has hit back with reciprocal import tariffs on the same value of American products. It's to levy a 25% import tariff on Boeing aircraft, for example. It's whacking tariffs on US vehicles and soybeans. It imports a third of the US total soybean exports. Now, Japan stocks just managed to cling onto marginal gains. This on the back of slight yen weakness, which is positive for exporters. The Nikkei share average rose 0.1%. Hong Kong stocks led the regional decline, with the Hang Seng Index closing down 1.5%. Despite the trade war heating up between China and the US, Chinese stocks lost, but not to the same extent as Hong Kong shares. The Shanghai Composite Index closed down 0.1%. Wall Street stocks ended higher last night after a choppy session. Investors are looking forward to the earnings season. Earnings growth for the first quarter is expected to range between 10 and 15%, with some analysts expecting it to be one of the best performing quarters recorded based on positive economic fundamentals in the US. The S&P pushed up above a key support level, while Amazon shares jumped on hopes that criticism from President Donald Trump would not translate to policy changes. The Dow Jones Industrial Average rose by 1.65%. The S&P 500 gained 1.26%, while the Nasdaq Composite Index added 1.04%. Let's take a look at more market news now. We cross to Nompumelelo Siziba at the Johannesburg Stock Exchange. Nompumelelo, lots of red on the JSE counters as well.
That's right, Nzinga. Things are not good at all. It would seem as though that trade war that was feared between the US and China has in fact begun. Both countries have decided to levy import tariffs on goods worth $50 billion. So there's an equalization of punishment, so to speak. But the question is, what's going to come thereafter? They don't seem to be any closer to negotiating a situation where they rather negotiate through the World Trade Organization. And so many countries concerned that they're going to be caught up in the crossfire. Of course, there's supply chains to be concerned about. Some countries or companies in countries may end up not producing as much because they're not able to export as much, and so on and so forth. So that is really informing global markets at the moment. The all-share index is particularly feeling it. It's down. It was down by as much as nearly 3% earlier in the session, with industrials and financials taking quite a hit. We see mining counters also down, but not to the same extent as those. I think the only ones that are sort of peeking their heads up are the gold counters, which are supported by a higher gold price, which is a safe haven asset, and people are ploughing into that. Before I continue, I'd like to apologize to viewers for the ticker that's going on there. The information that you're reading there is wrong. Everything is down at the moment, and I'm sure that will be corrected in due course. In terms of the local currency, we see that having lost quite a lot of ground vis-a-vis the US dollar. Let's take a look at the indicators. All right, to break down what's happening, I'm joined by Makwe Masilela. He's from Makwe Fund Managers. Thanks for joining us, sir.
Pleasure.
The trade heat is now on between the US and China. So for you as an investor of people's money, what does this all mean, and how is it now going to inform your investment strategies?
Very disturbing, and I think maybe we need to understand the whole implication, you know. Yes, the things have not yet triggered, they announced, so the Chinese are waiting for the US to start triggering the whole thing. But as you said, you know, people need to realize that China itself, for them to respond within 11 hours, you know, that escalated the fear. And more importantly, you know, we get most of Asian countries taking their things to China, where it's more of an assembly hub, and China start exporting that to the world, and mainly to the US. So it's not just a question of China that will be implicated. Then we've got Asian countries there as well. And China itself being the main consumer of commodities, it becomes a problem for countries like South Africa as well, because we know our major exports are commodities and to the likes of China. The US itself, you know, they have to be careful in the sense that the US is the largest economy. We have seen some pockets of growth from that end of the world, you know. So it's a very tricky situation. It's more kind of a two elephants, you know, fighting. And now what we'll do, you look at safe haven. Safe havens here, you are taking the likes of gold, which has responded positively. But another safe haven, which is the Japanese yen, is not responding accordingly, because given the who's with the American dollar, we should be seeing the yen to the dollar as almost 100 or 101. Now we're sitting on 106. That now start raising eyebrows. You start asking yourself that exactly what is happening. Is this just only trade or so? But yes, you'll quickly rush to the likes of gold.
And markets, as I've said, are obviously bleeding as a result of what we're talking about, but the all-share index particularly so. What's your analysis?
Unfortunately, the all-share, given that yesterday it was down almost more than 1%, and I think another thing that we need to factor in, for the past 2-3 months or so, we've seen what we call the LIP, or the London Interbank Overnight Rate, passing almost the 2%. The last time that happened, it was in 2008, and that's when banks were starting to be reluctant to lend to each other. So now we are seeing that happening again. It's sitting at almost 2.3. Now the all share, we've got Naspers, unfortunately, that counts for almost 20% of our market. For it to drop by almost 6% or so, it takes the market down with it. We've got, unfortunately, our retailers and banks. And bear in mind that Naspers is down almost 30% since November or so. Our retailers and banks, if you remember, before the ANC conference, when people were confident that we'll get the new president, stuff like that, we started seeing foreigners piling up into our retailers and banks. So we've seen them being down as well. And honestly speaking, our top 40 has been trading within the range of 44 to 48. You ask yourself that exactly what is happening, but unfortunately, Naspers is pulling us down. And yes, they sold that stake, almost 3% from Tencent, but for the fact that they said they're going to be locked in for another 3 years without doing anything, I don't think investors liked that part.
And then the local currency, we see that that has weakened quite substantially. Is that more to do with the general concern about emerging markets, or specifically commodity-producing markets like South Africa, you know, been caught up in this trade war and not being able to export their commodities?
Unfortunately, and bear in mind that the rand itself, it's more of a, when it comes to emerging market, it's very liquid compared to the other emerging market currencies. And yes, and being a commodity currency, unfortunately, it impacts on us, given that our exports might be, you know, affected when it comes to this whole thing of trade war. And we hope it doesn't escalate to become a full-scale trade war. But so far, we are starting to feeling it that, hey, things might not work out properly. Hence, we are seeing what is happening. And also don't undermine our own local issues. You know, this whole thing of land, people still have to understand how it's going to go about this whole thing. It's a question of wait and see. So people don't get too excited. Hence, we also see the rand trading within a range.
As I mentioned, it seems to be only the gold counters that really have just managed to keep their heads above water, because gold is a safe haven asset. Do you think that there is room for maybe speculating type of investors, traders, to go in there? Because I think this trade war thing is going to remain uncertain for quite some time.
For quite some time. And as you said, you know, it just threw out the fundamentals out of the window. So it's a question of whoever gets to speculate and get it right, you'll start playing the likes of your gold. And we've seen even oil itself, it went down because of this whole thing, and which is one or the other part of the commodities. So yes, you can start speculating on the likes of gold, and hopefully maybe yen, with time, it will also come into play. You can also start looking at this exchange rate between the yuan and the US dollar.
And let's look at one stock, Murray & Roberts. They've been pursued by a company called Aton in Germany, which was offering them quite a significant premium on their share price, but Murray & Roberts rejected it out of hand. But they've also announced, that is, Murray & Roberts has announced that they've managed to secure 3.7 billion rand in projects for the coming years, which is quite significant. What do you think about this stock, and why are they seemingly not interested in being taken over?
I think the board was clear. They said the guys are very opportunistic to give them that offer. Bear in mind that the guys already hold 30%. So they understood and knew that there is this deal which is supposed to come to fruition because they are the current shareholders as well. And Marion Roberts, you compare them to the likes of Group 5, Avon. I mean, they're the only stock when it comes to construction stock, which is up or just only around 15% or so. And now you check the other one, Group 5 is down 37%, Avon over 40%. And when it comes to this whole construction index, this year so far is up only 3%, so it's not looking that bad compared to what happened in 2015, you know, because it was down almost 47%. So comparing it with its own peers, I think Marion Roberts not looking too bad. At a PE of almost 9, a dividend yield of 2.5, I think it's worth looking at.
Okay, all right, we're going to leave it there. Thank you so much for your time, as always. Makwe Masilela is a portfolio manager at Makwe Fund Managers. After a short break, Nzinga has more business news for you.